Options trading can be quite tricky because on top of having to choose a stock, on top of choosing a strategy, you also need to choose the strikes for the trade that you're trying to set up. So comes the question how to select the strikes when you're trying to set up a trade, so you try to choose the best strikes possible. And if at any point you find this video interesting or useful and you'd like to see more videos like this one where I share how I personally do certain things in options, please consider subscribing to my channel and liking this video. That's really the best support you can give me and I'd really appreciate it. Let's imagine that you want to trade the stock PTON and you think the stock is going to go up. We're going to choose the January expiration, and when we open the option chain for the January expiration, in particular for PTON, you see that there are a lot of strikes available, and that raises the question, which strikes should you choose? Is there better strikes to choose when you're trying to buy a call or a put, or when you're trying to make any type of trade? And that's what we're going to see now. And the very first thing that you need to realize even before trying to set up the trade in a certain way is liquidity. Regardless of the strike that you choose, you want to go for what we call a liquid option, for a liquid strike. In other words, you want to go trade an option where there are already a lot of participants trading it. And why? Well, it's because it's going to become a lot easier for you to get in a trade and get out of a trade if the strike that you're choosing is very liquid. Meaning, if there are a lot of participants already trading that option on that particular strike, it's going to become a lot easier for you to get in a trade and get out of a trade. And I can tell you from experience that there is nothing more frustrating to trade an illiquid option, because if you are in a trade and let's say that you are in a profit right now, you were right in the trade that you wanted to make and you can't get out of the trade because there are not enough traders in that trade trading that particular option that you have chosen, you're going to be pissed. Hence why you always want to trade liquid options. And to be able to see which strikes within the January expiration that we're looking at are actually liquid, you need to check the open interest. And the open interest refers to the number of contracts that are currently being held right now. In other words, the bigger the open interest, the more liquid is the option, because the more participants there are actually trading that option right now. And the smaller the open interest, the less liquid the option, because there are less participants trading it right now. Hence why I say that you really need to choose a strike where there is a lot of open interest, so you can make sure that you can get in a trade and get out of a trade very easily. And to give you a ballpark number so we can actually quantify things, well, an open interest above 1000 is considered as very liquid. And to tell you what I would do and what I wouldn't do, I wouldn't trade an option if it has, for example, an open interest of less than 200. For me, it's really not enough liquidity so as to be able to get in and get out of a trade easily, and I don't really feel comfortable trading an option that has an open interest of less than 200. And now when you look at the January expiration and you have all of those strikes that are available, and we choose the open interest and we start comparing all of the strikes together, we can already start eliminating some strikes that are not liquid enough. And I can tell you that from experience, if you already start doing this for each and every single trade you take, it's going to save you a lot of time and, more importantly, a lot of money. And after that comes the second consideration, the probability of profit. In other words, how right do you want to be? How likely do you want your trade to go in profit? Because if you want to be right very often, you absolutely can. But know one thing, the more often you are going to be right, the less money you're going to earn. And the less often you're going to be right, the more money you're going to earn. And that's really in options trading this balance that we're always playing with. If you want to be right all of the time, you absolutely can. However, you're not going to earn a lot of money. But if you want to earn a lot of money, you're going to have to give back probability of profit. And that's really this game of balance that options traders are always playing with. Hence why, for example, some traders are only focusing on having very low probability of profit, but when they win, they earn a lot of money. And some traders, they prefer to be right almost all of the time, but when they're right, they only earn a tiny bit of money. And when they lose a lot more money. And is there a better side to choose? Is it better to be right very often but earn a tiny bit of money? Or is it better to be right less often, but when you're right, you earn more money? And to be fair, there is not necessarily a best side to choose. Personally, and I'm going to tell you what I do so I can maybe give you an example, I prefer to be right more often and earn less money when I'm right. Why? Well, I truly believe that, at least for me, it's better to have 9 winning trades and only 1 losing trade rather than having 9 losing trades and 1 winning trade. Let's imagine that you're profitable in both cases. I prefer to be right more often rather than being right less often. I think that it makes trading a lot easier and it makes trading a lot more pleasant. But after that, if you want to be right less often and earn more money when you're right, that's absolutely fair, and a lot of people do it. For example, there are some hedge funds that only focus to make money when there are actually stock market crashes, and when there is a stock market crash, they make a lot of money, but 99% of the time they lose money. But when they earn so much that it actually makes them profitable. So you see that you can really choose anything you want. If you want to be right less often or more often, that's completely fair. And the Tastyworks platform has something that is very cool that is already built in. You can actually see your probability of profit directly when you're trying to set up a trade. So in that example, which strike would be better if we were willing to buy a call? Well, what I would do personally is probably to choose a strike that is closer to the at the money strikes, and the at the money strikes represents the strikes that are the closest to where the stock price is actually right now. So right now, the closest at the money strikes will be around 110, 115. So you see that it's probably better when you try to buy an option to choose a strike that is closer to the at the money strikes, so you actually have a balance. You have enough probability of profit to be right, but your max loss is actually not that big, meaning you don't risk a lot of money. But what happens if you sell an option instead of buying an option, like in our example for PTON? And that's personally what I really like to do, is only to sell options. And the very good thing about selling options is, in my opinion, you have a lot more control. And when you sell an option, you see that your probabilities of profit are going to be a lot bigger than when you were buying an option. If you remember, when we were looking at buying a call, our probability of profit was around 44%, compared to when we sell an option, we want to have the option expire worthless. And you can see that the further out the money you go, now we start having those probabilities of profit that start increasing like crazy. And when I sell an option, I personally like to sell an option where I have a certain balance between the probability of profit and the reward that I can get. But let's imagine that in that case, we're selling options, and to protect my max loss, I'm actually doing what we call a put credit spread, meaning that I'm selling an option and I'm buying an option at a lower strike, which represents an option with a lower price. And in that case, when you're trying to trade spreads, it's really important to consider your probability of profit and the potential reward that you can have. Because here's the thing, if you go too far at the money, you might have 99% of profit. However, you are not going to earn a lot of money, and what you risk is a lot bigger than what you can earn. And now we're going to talk about something that is very, very important when you try to sell options. The trap is that it's very easy to sell very far at the money options and not have enough max profit, meaning that yes, you have a very high probability of profit, meaning that you're going to earn very often, but you're not going to earn enough so as to offset the potential losses. And that's personally something that I was going through when I started trading options. I was, for example, selling put credit spreads very far at the money, meaning that I was very happy to say that I had a 95% win rate, but when I was looking at my overall P&L, my losses were a lot bigger than all of my winners. And if overall you're not in a profit, well, what's the point of having a high probability of profit? So you really need to have a balance between the probability of profit and the potential profit that you're going to make when you win a trade. And you really need to pay attention to this. And that's something that I've discussed in a video that I've made, which is called the trap of credit spreads, where I basically talk about the fact that it's very easy to go very far at the money so as to have a very high probability of profit, but not collecting enough credit. And so when you have a loss, it always offsets all of the winners that you had in the past. And I know it's something that a lot of people are going through, so don't hesitate to check it out if that's something that helps. And if I had to say one rule of thumb to follow that you will find in the video that I just mentioned that I've done, when you're selling spreads, for example, put credit spreads or call credit spreads, try to collect 1/3 of the width of the strike. What does that mean? Well, the width of the strike represents the distance that there is between your short option and your long option. In our case, if we look at PTON and I try to sell a put credit spread and I have a width of the strike of $5 and collecting 1/3 of the width of the strike would mean that I try to collect $1.65 on my put credit spreads. And that's a good rule of thumb that is going to help you earn enough money compared to the potential losses that you could have. And if, for example, the width between the two strikes were of $1, then in that case, you would try to collect at least 33 cents in terms of credit. In the end, if we had to recap, how you should choose your strikes would depend mostly on the liquidity liquidity, meaning that you need to make sure that the strikes that you want to choose are liquid, and you also need to be mindful of the probability of profit and the risk reward, meaning that when you buy an option, it's probably better to buy an option that is closer to the at the money strikes, and when you sell an option, or for example, as we said before, a put credit spread or a call credit spreads, it's better to choose strikes where in the end you collect 1/3 of the weight of the strikes. And by doing this, you ensure yourself that you have enough profit so as to offset the potential losses that will come. And I hope it all made sense, and now you understand a bit more on how you should choose your strikes and what things you need to consider when you're trying to set up a trade. If you have any question, you can absolutely join my Facebook group, which is called Option Trading 101, where we can talk directly together, where you can basically ask me any questions that you could have. If you've been watching until the end, I really thank you very much. I really hope that you enjoyed this video, and if you've been liking it, please consider subscribing to my channel and liking this video. As I said, it's really an amazing support and it really helps me know which type of videos you'd like to see more. Please take good and informed decisions. I wish you all the best, and I'll see you in the next video.